This is 2006 paper 2 question 3. Okay, what is the question actually asking? So this is section B, question 3. Ang and Bin each run a small business. They agree to form a partnership from 1 October 2005. But each of them continue to prepare their own accounts until 1 April 2006, after which their accounts were amalgamated. Amalgamated means join. Okay, so so this one is 10 months, this to 31st March 2006, this is 9 months to 30. You see, this is somewhat similar with the previous question I explained in part 1. Okay, so what the question is asking is, say, calculate the division of net profit of each business for the period ended 31st March 2006 to the period before and after formation of the business. Okay, for the period ended for the periods ended 31st March 2006 to the period before and after the formation of partnership. So when was the formation of the partnership? Okay, they said they agree to form a partnership from 1 October 2005. Okay, so that so they are saying that calculate the division of the profit of each partner for the period ended 31st March 2006 to the period before and after the formation of the partnership. So now you look at the question here. Here, 10 months ended 31st March 2006. So the partnership was formed on 1 October 2005. So the period, so that means this one 10 months to 31st March 2006. So that means if you calculate, it means, okay, March, February, January, December, November, October. So that means the 10 months, it actually, if you calculate, it actually means from 1st June 2005 to 31st March 2006. So the period before the formation of partnership for Ang will be 1st June 2005 to 30th September 2005. That is the period before the formation of partnership. And the period after the formation of partnership would be 1st October 2005. Okay, the period is ended to 31st March 2006. So now I have an idea already. Okay, this question only carries 2 marks. So they are supposed to calculate the profit. So you should have the question with you. Okay, so now I have sorted it out already. 1st June 2005 to 30 September 2005 is 4 months. And 1st October 2005 to 31st March 2006, this is 6 months. So in the question, Ang, the net profit is 130,000. So if you prorate it, if you take 130,000 times 4 months over 10 months will be equals to 52,000. This is how I get 52. This is in 52,000. So this 78,000, how do I get it? I get 6 months divided by 10 months times 130,000, because the net profit for Ang for the whole period is 130,000, so it will be 78,000. So same here, Bin, I get it from the same method. So part B of the question says calculate the capital account balance for each partner at 1 October 2005. So you are given here the capital at 31st March 2006 is 173,000. And then so this one for 10 months ended 31st March 2006, you have drawings here. Okay, so you have the question paper with you. So the capital account balance at 31st March 2006 is given in the question, 173,000. Okay, drawings. So you are supposed to calculate the capital at 1st October 2005 as asked in the question. Okay, So now in the question there, in the question, this is, you see, this one is 10 months. This one is 10 months. The drawing is 115,000. So this from 1st October 2005 to 31st March 2006, that is actually 6 months. Okay, that is actually 6 months. So you see the drawings for the 10 months for Ang is 115. So how much is the drawings for 6 months? So you will take 6 divided by 10 times 115. So the drawings for 6 months is 69,000. Okay, this is in thousand. So Bean will be the same. Bean, you will take 63. This is how many months period? This is 9 months. Okay, this is 9 months. So you take 63, so you take 6 divided by 9 times 63. You will get 42. So 42,000 is the drawings for this period. Okay, you see, this is the capital at the end of the period. At the end of the period, which would have been obtained after deduction of the drawings. So now we want to roll backward. Okay, so that means the capital at the beginning of the period would have added the drawings, because this balance at 31st March 2006 is after deduction of the drawings. So you want to roll backward to the capital at the beginning. So you add the drawing, and you minus the net profit. You see, this net profit is calculated here from 1st October 2005 to 31st March 2006. So, and then you minus the net profit in order to get the capital at the beginning of the period. Because this capital is obtained after added of the net profit, after adding of the net profit. So in order to get back the net profit at the beginning of the period, you minus the net profit, which is calculated in A. So you will get the capital at 1st October 2005. So as explained in the previous question, when you form a partnership, both the partners, I've explained very detailed in the previous question in part 1. So you will calculate the goodwill of both the partners. So the agreed goodwill of 1st October 2005 is these two, and goodwill is to be included as an asset in the partnership account and written off in 10 years equal installment at the end of each accounting period. Okay, why is it at the beginning of the partnership they add it? Okay, this one I have already explained. So you add to the partnership capital account. But is it the goodwill that has been generated? So for example, a father started a business, so he has worked very hard to generate the goodwill, like a good customer relation and all this. So the goodwill will be so-called eroded as time goes by. So that means assuming that the goodwill generated by the father, and then when the son took over the business, the son, let's say for instance, if the son does nothing to maintain the goodwill, the customer will eventually will slowly over time give up their loyalty to that business, and also so does all the other goodwill, like reputation and everything. So goodwill will be eroded over time. I know the new business owner can generate their goodwill. So you see, the effort put in by the new business owner to keep up with the goodwill, that is the effort by the new business owner. So what I'm saying, that the goodwill generated by the old partners will be depreciated over time, will be eroded. So that's why they are saying that the goodwill included in the asset in the accounts, and it is to be written off in 10 equal installments. That's why they are saying that the goodwill will be reduced over time. Okay, so the goodwill in the question will be added. So the question says calculated the adjusted capital account at 1st October 2005. So this is the capital accounts, adjusted capital accounts at 1st October 2005. So they say calculate capital accounts means the corrected capital accounts at 1st October 2005. Okay, then part C of the question says prepare the bank/cash account for the 6 months ended 30 September 2006. So this is bank/cash account for the 6 months ended 30 September 2006. So that means it will be from 1st April 2006 to 30 September 2006. So as given in the question, this is bank balance, and then this is a bank overdraft. So what is the net bank overdraft? So you can either put it net, or I can put it like put both balance brought down. So balance brought down, the debit balance is 12,000. This is in thousand, and the bank overdraft is 32,000. So I put both. You can net it off also. So now you can go to note 5 of this question. Okay, so this is cash sales. Okay, you see this one is actually quite easy. Okay, bank cash account, this debit side, it means money come in. Okay, credit side means money go out. Okay, this one I've if you have followed through, you would have known, because bank or cash account is a debit nature. So on the debit side means money come in, credit side means money go out. So if you look at note 5 of the question, cash sales, okay, note 5 of the question says transaction for the 6 months ended 30 September 2006 were as follows. Cash sales 1780, so this is money come in. Okay, then, okay, receipt from debtors, you hold on first. Okay, then this one, cash purchases 220,000 is also from note 5 of the question. Okay, you see in note 5 you say supplies bought for cash 220. So operating expenses paid in cash is also given in the question. Loan interest paid is also given in the question. Loans repaid is also a money go out, so it's given in the question. That's why I put there. Okay, then this one, fixture and fittings purchase 120, but in note 6 it says that new fixture. Okay, so now you see note 5 and note 6. Fixture and fittings purchased 120. Okay, so this is fixture and fitting purchase. Note 6 says new fixture and fittings purchased during the year cost 190,000, but a part exchange allowance 70,000 was received for some old fixture and fittings which cost 140,000 and had the written down value of 58,000. Okay, so that means the new fixture and fitting purchase is 190,000, but you have traded in part exchange allowance. That means you have traded in your old furniture for 70,000. So that means, okay, so that means you are supposed to pay 120,000 to the furniture and fittings vendor. But note 8 of the question, you see, at 30 September 2006, that means this is the year, and 30 September 2006, creditors for new fixture and fittings is 20. So that means you buy the furniture and fittings, you're supposed to pay the vendor 120. But at the end of the year, you still owe the creditors for the furniture and fittings 20,000. So that means you have paid 100,000. 120 is what you're supposed to pay, minus 20, which is what you have not paid yet. So that means you have paid the fixture and fittings vendor 100,000. 100,000 is the money go out. So this one, drawings is also a payment for this period, for this 1st October, 1st April 2006 to 30 September 2006. So this is for a 6 months period. You see, note 7 of the question says monthly drawing were made in the same amount per partner, okay, as previously to 31st March 2006. So that will be easy. So that means this is still 6 months period. The drawings would be at the same rate previously. So this one is this drawings is actually for 6 months. For 6 months, so Ang is 69,000, so it will be at the same rate. Okay, payment. So that means we have left payment to creditor and receipt from debt. So receipt from debtors is what we learned before. Okay, So the beginning of the period is 31st March 2006. So that means you take 11 plus 12. Okay, 11 plus 12. This is the debtors at the beginning of the period. Add your credit sales at 260. Okay, 11 plus 12 at 260. That would be what your debtors supposed to be, assuming you pay nothing. Okay, so you take 11 plus 12 plus 260. That will be equals to what your debtors supposed to be, assuming you paid nothing. But at the end of the period, your debtors is only 42. So you take that figure, then you minus 42. Okay, that will be 241. Because you take 11 plus 12 plus 260 will come to a figure that is a figure that what your debtors supposed to be, assuming you paid nothing. Okay, but you only owe your debtors 42. That means the difference. So that means the difference, that means you minus 42, that will be equal to 241. The difference 241 is 241 is actually what you the payment, the receipt, I mean, assuming that they pay nothing, so that would be the receipt that you receive from the debtors during the period. So it's 241. So similarly, payment to creditors. Payment to creditors, you will take your creditors at the beginning of the period, that is 140 plus 71. Okay, 140 plus 71, that is the creditors at the beginning of the period. Add supplies bought on credit at 1070. Okay, will be equals to 1281. What is 1281? 1281 is the amount that we owe the creditors, assuming we paid nothing. Okay, it will be 1281. But at the end of the year, we only owe 350. So that means 1281 minus 350 is equals to 931. 931 is how much we have paid the creditors, payment to creditors. Okay, 931. Okay, so then now you close this account. You see which side bigger. Okay, I calculate this side is bigger, put the same number. This one minus everything is 214. Balance carried down. So balance brought down would be on the debit side. That means it's a positive cash or bank balance of 214. Okay, then part D says prepare a profit and loss account and a balance sheet, so showing detailed breakdown of the capital account of Ang and Bin. So you're supposed to do the profit and loss account for 30 September 2006 and a balance sheet. Okay, so then what you're supposed to do is you lay out your question first. So sales, you look at note 5 of the question. You just add credit sales with cash sales, then you will get 2040. That means you add 260 plus 1780, you will get 2040. So opening stock, so that means the stock at the beginning of the 6 months period. That means the stock at the beginning of the 6 months period, you will add 90 plus 55,000. 90,000 plus 55,000, which is this one plus this one, because this is the stock at the beginning of the period. Beginning of the 6 months period will be 1st March 2006. Okay, so that will give you 145. Then purchases under note 5 of the question, you just add you just add the supplies bought on credit, and then you of 1070, and you add 220 supplies bought on cash, so you get 1290. So closing stock is under note 8 of the question, note 8 in the question, 280. So you get this one, gross, then 2040 minus this one, you get gross profit. Okay, gain on disposal of fixed asset, you look under note 6. You look under note 6. Okay, so the supplier give them a trade-in value or a part exchange allowance of 70,000. Okay, was received from some old furniture with cost 140 and the written down value is 58. Written down value, that means the net book value of the fixture and fittings. So your fixture and fittings, the net book value is 58,000. The supplier give you a trade-in value of 70,000. So that means you actually profit 12,000. So this profit will be put in the profit and loss account. Gain on disposal of fixed asset. Operating expenses is under note 5 of the question, 415. Depreciation of fixture and fittings is given in note 5 of the question as well, 110. Okay, you see note 5 of the question says depreciation for the year on fixture and fittings. Depreciation for 1 year, okay? So this is a 6 months profit and loss account. So you should times 6 over 12, so you get 55. Loan interest is also gotten from note 5 of the question. So amortization of goodwill. So goodwill, they are saying that the goodwill is to be written off in 10 equal installment at the end of each accounting period. Okay, so the goodwill is they said, okay, in note 1 of the question, additional information note 1, goodwill is 35,000, Bean is 25. So that means the total goodwill is 60,000. And then so that means I am assuming, because we 31st March 2006, I have assumed that they did not amortize their goodwill in their profit and loss account. So that means for this first account, 30 September 2006, I should amortize for the whole year. So they are saying that goodwill should be amortized in 10 equal installment at the end of each accounting period. So I just take 60,000 divided by 10, because this is the first joint partnership account that they are doing. Okay, previously for the 31st March 2006, they did not do a partnership account. So that's why this one I'm taking the goodwill for the whole year. Okay, so now I add all these expenses is 476, then I get the net profit. So when after I have laid down okay, balance sheet will lay it out. So here, okay, so I will explain the easy one first. So in the exam also, once you've laid it out, you can put the easy number first. So goodwill will be the original amount, 60,000, minus the amortization. Amortization is similar like depreciation. So that's why we get goodwill 54,000. Okay, stock is 280,000 is gotten from note 8 in the question. And then debtors is also gotten from note 8 in the question. Bank is what you calculated in part C here. So the balance brought down will be on the debit side. So bank is a debit balance. Okay. So all these current asset figure are easy. Creditors is also gotten from note 8 of the question. Fixture and fittings creditors got 2. Creditors for fixture and fittings also gotten from note 8 of the question. Loans. Okay, loans. Okay, loans is you take this loan at the beginning of the year minus the loan repaid, minus 8,000. So loan is 30,000 minus what is paid, minus 8,000. So so that gives you your loan is 22,000. So until here the figures are easy. So now how about fixture and fittings is a bit difficult count, so I put in working 2. Okay, so fixture and fittings will be your fixture and fittings that is given in the question. Okay, 173, and in the question the fixture and fittings is 200 and 153. Okay, this one is the fixture and fittings at the beginning of the year, 200 plus 153. Okay, plus what you bought, plus 190. This is what you bought. Okay, minus the net book value. This is the fixture and fittings at net book value. The fixture and fittings, if it's just one figure in the balance sheet, this is the net book value, fixture and fittings. Okay, plus what you bought, 190, minus the net book value of the fixture and fittings that was sold. So this one, because it's sold, that means it's go out, right? So minus 58. Okay. And then you must minus the depreciation of the fixture and fittings during a year, minus 55. So this is how you get it. 200 plus 153 plus 190 minus 58. Okay, you get 485 minus the depreciation during the year. So the fixture and fittings during the year is 430,000. Okay, 430,000. So now, okay, so this one is equity capital. They did not do a current account during the period, so everything put in the capital account. That is what the question implies. Okay, so capital at 1st October two, 2000 and at 1st October 2005. Okay, capital at 1st October 2005 is 199 and 106. Okay, 199 and 106, which is what I calculated in part A of the question. So now we are supposed to find the capital at 30 September 2006. So now I'm doing like a 6 monthly period first. So from 1st October 2005 to 31st March 2006, they have the drawings for the 6 months is so much as we have calculated in part B of the answer. Then net profit, you see, this is supposed to be the partnership uh net profit. Okay, the partnership net profit for this 6 months from 1st October 2005 to 31st March 2006. So according to what I have calculated in part A, okay, this 6 months is 78 and this is 48,000. So that means now we are supposed to calculate the, okay, so this is the total profit of the partnership for this 6 months period, and they are supposed to be divided. The partnership started from 1 October 2005. So their partnership sharing ratio, as stated in additional note 4 of the question, profit are to be shared for Ang 60%, Bin 40%. So this is supposed to be the share of profit. Okay, so then this is the corrected capital at 1st April 2006. And then again now we'll roll forward, so you less drawings, and then you add the net profit. You add the net profit for the 6 months period. How you add the net profit? You take 419. Okay, so you take 419 is the profit for this period times 0.6, it times the 60%. So this is how you get 251.4. So Bin is 40%. Bin will be 419 times 0.4. Okay, so this is 167.6. So this will be your corrected capital for each of the partner at 30 September 2006. Okay, so here is it. And then with that I have finished the question for you already. Thanks.